Hello, Steve Lance here with Discover Options, and welcome to this edition of the Market Reports. Today we have two reports for you: the S&P 500 Condor and Butterfly Timing Report, then also the S&P 500 Market Likelihood Report. Both of these reports have some very unique technology behind them, unique to Discover Options. Let's give you a short preview of the Condor and Butterfly Timing Report here. Bottom line is, right now it appears there is a negative edge to selling premium from using condors and butterflies. When you look at the past and you look at the market condition we're in now, it's more likely than usual that for the condition we're in ending up on Friday, it's more likely than usual that we'll end up having an unfavorable environment for doing condors and butterfly trading. Okay, that's the preview. On the likelihood stuff, take a look at the likelihood report. Many of you have watched this report presentation before. You know what all this means. We're going to get to this in detail in a little bit. Bottom line is you have a lot of blue numbers here, and you're seeing a picture of expanded market volatility. All right, there's a likelihood that in the future, in the next 5, 10, 15 days, we'll have more market volatility than what is usual if the past holds true. Okay, there's just that likelihood we'll have expanded volatility. And all this is stemming from our current market environment, which is this. Thursday was a downswing day, lower high, lower low. Friday was an upswing day, higher high and higher low. All this is when the trend is downward. The close was underneath the 50-day simple moving average. And the 15-3 stochastic is right now kind of in the mid-20s. Roughly, the market condition I'm defining is between 1 and 50. We're barely above the 3-day simple moving average. This is a very unique market condition where we're in a downtrend. Stochastics turned up with an upswing day, and that condition has occurred about 100 times since January of 2000. When you look at what has happened with those 100 times, that's why we're drawing the conclusions that we are regarding butterflies and regarding the likelihood of expanded market volatility. All right, so before we get to the reports, encourage you to subscribe by clicking on the button below. Also, I encourage you to come get a free e-trading book co-authored by myself and Jim Graham, Simple Steps to Options Trading Success. Clicking on the link in the above right will get you there. Okay, now let's get into the details of the reports. Just how we do this, the methodology and so forth, why we look at the butterfly timing report, why it's important, and then we'll take a look in detail at the current condition and the edge level. Why would you look at this? Well, our algorithm is very unique. For example, when you look back at December 31st of 15, it would have looked like the market was beginning to chop around in a nice channel there. Well, when you run the numbers and run it through our very unique algorithm that I use in Metastock, turns out that there was a minus 4.2% edge. And it just so happens at that time that turned out to be somewhat predictive because, well, at the time, what does a negative edge mean? It means that there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. More volatile than what was implied by the option prices. In this case, the market did indeed get very volatile after that. Of course, that's a cherry-picked example. It's a perfect example of what can happen if you ignore the negative edge that was sitting here kind of as a warning to Condor and Butterfly folks. I went over the current condition. Here's the question, though, on the table with regards to the butterfly report. Is this current condition a good one for selling option premium through range trading, butters and condors? Is this current condition a good one, the one I just described? Okay, so we answer that by going through a few steps. First, we have to understand what actual volatility is, how the market moves actually, from a given close. Then we look at implied volatility and understand that, what the implied move is at any given time. And then we compare the two and in hindsight conclude whether a bar turned out to be favorable or unfavorable. I'm going to walk you through that process and show you how important that is in understanding, just coming up with statistical likelihoods of success here. So first thing, we have to look at the actual move that can happen. We have to understand the actual move. So you can take a close at, in this case, the close in April 28th or so. Moving forward 21 bars, we ask ourselves, how far did the market move either up or down? What was the extreme level? Well, it went down, in this case, 50 points, which turns out to have been 2.4%. And we can graph that as you see here in our Metastock program. Now, here's a question. At that time, what market move was being implied by the option prices? Okay, all this stuff is very important to butterfly and condor, folks. Okay, we have to understand implied volatility and the implied move and the statistical volatility, the actual move. Okay, so we know that the actual move was 2.4. When we look at the VIX at the time, the VIX was implying a move of 4.4%. 4.4%. That's higher than what actually took place. All right, so do you think that that would have been a good time to sell a condor or trade a butterfly? Well, of course, you would have been selling implied volatility premium at a 4.4% implied move versus what actually happened is a 2.4% move. That would have been good. And so what we do is we paint those kind of favorable bars blue. We paint those bars blue, and the ones where it resulted in more volatility, the market moved more than what was being implied, okay, that's where we paint the bars red. And so what we end up having is a whole bunch, every bar is painted blue or red, going back, favorable or unfavorable. So what we do is we look at historically what percentage of the bars are favorable. If you go back to January of 2000 in the SPX, what percentage of bars turned out to have been favorable for selling condors and butterflies, where the implied volatility was higher than the actual? Okay, then we're going to compare what the, look at the second one, of the bars that match our current market condition, what percentage of those were historically favorable for selling premium? And then we look at the difference, and that represents the edge, negative or positive. So when you go back and look at all 4,200 or so bars, 65% of them turned out to have been favorable, where the implied volatility was higher than the actual volatility. The implied move was greater than the actual move, 65%. Now, of the bars that match our current condition, and I'm showing you roughly, well, there's one where, we're on the right hand, and that's, of course, we don't know yet. But if you go back in time over the last year, you can see we had 1, 2, 3, 4, 5, 6, about 6 bars on this screen that matched our current condition. If you go all the way back to Jan of 2000, we have about 100 of those that have that green triangle sitting there. Of those 100, about 50% turned out to have been favorable bars. 50%. Now, when you compare 50% versus the 65%, which is the baseline out of the 4,200 bars, what does that mean for us? It means we have a negative edge. Okay, and our current market condition results in 50% being favorable. Normally, you could just flip a coin at any given time. You'd have a 65% chance of catching a favorable bar. Under this current market condition, you have a 50% chance of catching a favorable bar. That's a 15% negative edge, okay? So if you're a range trader using butters and condors, beware that this condition, you might catch a favorable bar right now. I don't know. But it's more likely than normal that you won't. You still have a 50% chance. However, that environment is not as favorable as we've had in the past. Okay? So, that's where that report currently sits, and we'll be back next week with the same kind of report, and we'll see where we're at then. Before we go to the likelihood report, just want to make sure you understand that Discover Options, we offer a wonderful array of curriculum offerings with one-on-one mentoring in all of our course offerings. Every course we teach comes with a 1-hour session between you and an experienced options trader, money manager types that manage accounts and really know their stuff. We have a great staff: Ken Dole, Frank Fahey, Steve Papali, and you can go through all of these. Go into our website, look at the curriculum. The equity track down there has 14 courses, taking you from an intermediate level to an advanced. We have a whole bunch of other offerings, earnings announcements. We'll get you up to speed on how to trade earnings. Futures options, folks. We have a great futures track with Paul Forcioni helping us. And then the covered calls, puts, and collars, helping those of you with long portfolios. Just real nice ways to do option overlays and supplement your portfolio with an option overlay approach to extracting more yield with less volatility. Okay, check us out. We'd love to hear from you, and our folks at the office will help set you up with a custom curriculum if indeed you need that instead. The market likelihood report as it stands looks like this. Lots of blue numbers. Let's examine that. What we're looking at then is the current condition and asking this question. Since Jan of 2000, how often has this same condition occurred? The one I just described, price action trend and the stochastic. How often has this occurred, and what did the market do in terms of direction and volatility? Did it go up, down, wobble around, less volatile, more volatile, etc.? So that's what we're seeking to do, is to go back and look at the price distribution. And let me go to that. Here's our methodology here. We want to understand first the historical distribution of price. We look at all 4,200 bars and look at how price was distributed from each close. Then we want to understand the price distribution after a specific market condition develops. That's the one we have now. Of those 100 times our market condition developed, what happened? What was the price distribution after our current condition developed in the past? We then compare the two. We compare the baseline historical with our market condition distribution to see if there's an edge. All right, so here's how we do this. How do we define distribution of price? Okay, here's what we do. We measure distribution by observing how often price touches a one standard deviation volatility bands, the one standard deviation bands that are placed from each bar's closing price. You know what? Let me do this. I'm just going to put a D right there. That are placed from each bar's closing price. Okay? 3 sets of bands, 5, 10, and 15 days out. One standard deviation from the close, using a 20-day statistical or historical volatility number. Log normally distributed, of course. Here's just an example real quick. Okay, we take, these are 10-day bands. We set one standard deviation from the close. We go out 10 days. And we're asking ourselves for this close, did price go up and hit the upper band, go down and hit the lower band, or wobble in the middle and stay the same? And in this case, what we find is that price, let me do this. Click, timeout, click. Boom, there we go. Price indeed went up and hit the upper band in that case. All right, so for that close, we then, for this close here, we designate that it actually hit the upper band. It hit the upper band. Now, excuse me, oops, let's go to the next one. Here's this close. Let's look at another example. Here's the upper band, the lower band. What did price do? In this case, price went down and tried to hit that lower band, but failed to. Do you see that? It just didn't quite make it. So in that particular close, it hit neither. So for every close, we record what price did and how often price struck the upper and the lower 5, 10, and 15-day bands. From every close, we measure that, whether it hit those bands at 5, 10, or 15 days. That's how we measure historical distribution. And here it is laid out as of Friday the 14th, dating back to January of 2000, 4,222 occurrences. It hit the upper band 29.2% of the time. Okay, of those 4,200 plus, it hit the upper 10-day band almost 23% of the time, the upper 15 almost 23%. The lower 5, about 30, the lower 10, about 30, the lower 15, 32.4. So that's just the baseline distribution of price. That's our baseline. Now let me ask you something. If we find a technical analysis event and you discover that when you go back and look, that every time that particular setup occurred, price would hit the upper 5, 10, and 15-day volatility bands 100% of the time, and then it would hit the lower 5, 10, and 15-day bands 0% of the time. Would you agree that that would sound like a very, very bullish sounding setup? Probably the Holy Grail, right? I mean, going back in time, every time that setup occurred, you would have that kind of price distribution. Okay, that's what we're seeking here through this technology that we developed in Metastock here. Okay, so let's take our current market condition though. Here, let me go over here, click, come here. There we go. So now we're going to understand the distribution after a specific market condition develops. Hopefully the current market condition gives us something like what I just described. It rarely happens though, I have to tell you that. Here's what we're going to do. We're going to go back and look at each instance where our current condition developed. We're going to look at the distribution of price at the close. If price goes above the high from Friday, the previous bar, or if price goes below the low. That way, when Monday comes, folks, you'll have an idea. If price goes below Friday's low, you'll understand what the historical distribution has been, and if it varies from, if it goes above the high from Friday. Sometimes it can be quite different from each other. Here's what we get. As of the close on Friday, that condition occurred 101 times in the past. Of those 101 times, 22.8% of the time it hit the upper 5-day band. Now, that's less than the 29. Okay, so it apparently, it would go up and hit the upper 5-day band less often than less often than normal. The upper 10-day band was at 24.8, which is a little bit more. Hit the upper 15, 28.7, which is a little bit more than the historical, the benchmark. Look at this though. Price would go down and hit the lower 5-day band, 10-day band, and 15-day band significantly more often than normal. So what is this telling you? This is telling you that there's a bit of a bearish bias here. Those lower bands are getting struck quite a bit more often than the benchmark. All right, and these numbers for the lower bands are higher than the upper bands. So we're seeing a bearish bias here. Okay, now what's interesting too is that you have the lower bands getting struck more often by quite a bit, and 2 of the 3 upper bands getting struck by a little bit. So we're seeing a picture of expanded volatility here. I hope that that's obvious. Now, if price goes above the high from the previous day, the high from Friday, what do we have? Well, we have a bit of a similar condition here. 5 of the 6 bands are getting struck more often. On the downside, clearly not as much, of greater numbers as normal, but I think you get the picture that we're seeing a picture of expanded volatility. And if it goes below the low, that's when things get real interesting. Look at that downside. It only happened 28 times. But look at these lower bands getting struck quite a bit more often. 16, 17% more often than normal. And then 2 of the 3 upper bands are getting struck more often than normal. Again, a picture of expanded volatility. Now, one thing I like to do is take this same methodology and I recast the bands using skew-adjusted VIX. Rather than using a 20-day statistical volatility number, I'm going to take the VIX and divide it up between an upside VIX and a downside VIX. And I do that because in the SPX options you have a vertical volatility skew where the out-of-the-money call options have lower implied volatility than the out-of-the-money puts. And the SPX options, really, you can't really assign a single VIX number to both upside and downside implied moves. because embedded in the SPX options you have a vertical skew. We have to factor that in. If we're gonna answer the question, what is the VIX implying about an upside move? Well, it's going to be different than the downside implied move based upon the SPX vertical skew. So I take that skew. The SIBO publishes an SKEW symbol that reflects the magnitude of that daily skew. I run it through an algorithm, apply it to the VIX to come up with an upside and a downside volatility. The upper bands are a little bit closer to the close than the downside bands, which are farther away than the upside bands, to reflect that skew. I recast the bands then using these two different numbers. The VIX is generally higher than statistical volatility, and so that's why you'll see here that the upper and lower bands are the baseline is that they're getting struck quite a bit less often than the statistical volatility bands. All right, but nonetheless, you see a similar picture here of expanded volatility where most of the bands are getting hit more often in any of these instances here. Okay, so I think this paints the same picture. We're looking at a bearish bias, we're looking at expanded volatility, and it kind of speaks to the negative edge that we were having with the butterfly and condor report. There you go. There you have the two reports. Now, moving on, I have just a little bit of a trade idea for you. If you have to trade, oops, I'm not using a bull put spread. I'm using a butterfly instead. Here's just an idea. If you have to be in the market because you're managing money and your clients expect you to be in the market no matter what, and some folks, that's what they have to do, you may want to lean it a little bit bearish. I would suggest something like an offset put butterfly like this, an offset broken wing butterfly, where we're going out 30 days or so. All right, and you're doing you're going out maybe 40 points in the November options, and then you find the strike down here such that your total cash flow is going to be pretty close to zero as you can get. When you analyze something like this, what you're going to see is that your T+0 exposure is quite flat. That's what's beautiful here, is that you get positive theta with your delta being pretty flat and your gamma being very small as well. See these numbers here, down here in option view? Okay, and that's just the beauty of this kind of a trade, is that you can get positive theta and your deltas are pretty flat and your gammas are pretty pretty flat as well, so you're not getting a lot of slopiness and curviness to your T+0 line. And as time goes on, that theta is going to kick in, and that's where you make your money. And so you'll notice here that the market could go down quite a bit before you start experiencing some trouble, down here. Okay, so that's just a trade idea for you to consider when you go and look at the price chart and the profit region. It's green for a nice region there, and it affords you some bearish activity here. Yeah, I mean, we do need the market to chop around a little bit, but it does have a lot of room for error when you trade this way. Folks, thanks for joining us. I'm Steve Lentz with Discover Options. Love to hear from you. Trusted and proven. Phone number's there, the website's there. Look forward to working with you. Thank you. Bye-bye.